Most people believe investing is about intelligence, information, and complicated strategies. They think the smartest investors are the ones who know the most numbers, read the most reports, and predict the future better than others. But the real story of investing is very different. Again and again, history shows something surprising. Many intelligent people lose money in the market, while calm and disciplined investors quietly build wealth over time. The difference is not intelligence. The difference is psychology. The market is not just a place where companies are traded. It is a place where human emotions appear every day. Fear spreads during market declines. Greed grows during strong rallies. Excitement pushes people to chase rising prices. Panic forces them to sell when prices fall. These emotional reactions create a cycle that repeats through every generation. People buy when they feel confident. They sell when they feel afraid. And because emotions often appear at the wrong moment, many investors make decisions that damage their long-term success. The legendary investor Warren Buffett once said, "The most important quality for an investor is temperament, not intellect." This idea reveals a powerful truth. Successful investing is less about predicting markets and more about controlling your own mind. Benjamin Graham, the mentor of Warren Buffett, explained the same idea in a simple sentence. The investor's greatest problem and even his worst enemy is likely to be himself. Every investor faces an invisible battle. It is not a battle against the market. It is a battle against impatience, fear, overconfidence, and emotional reactions. When prices rise quickly, the mind whispers that the opportunity will disappear if you do not act immediately. When prices fall suddenly, the mind warns that things may become worse. These emotional signals feel real and urgent, but they often lead to poor decisions. Understanding investor psychology helps people escape this trap. It teaches investors how to stay calm when others panic. It teaches patience when others rush. It teaches discipline when emotions become loud. Throughout history, the most successful investors have shared a common trait. They developed rules that protected them from their own emotions. Charlie Munger once said, "The big money is not in the buying and the selling, but in the waiting." Waiting requires patience. Patience requires emotional control. And emotional control begins with understanding how the mind works during financial decisions. This book explores the psychological rules that guide wise investors. These rules are simple but powerful. They help investors avoid common mental traps and build long-term discipline. Each rule focuses on a specific behavior that shapes financial decisions. Some rules teach patience. Some explain how crowds influence thinking. Others show how emotions quietly affect judgment. Together, these ideas form a mental framework for smarter investing. The journey begins with the most important foundation of all. Before an investor can control money, they must first learn to control their emotions. This leads directly to the first and most essential principle. Rule 1. Control emotion before controlling money. Every investor enters the market believing they will make rational decisions. They study charts, read reports, and listen to experts. At the beginning, everything feels logical and controlled. But the moment real money is involved, emotions begin to appear. Prices move unexpectedly. News headlines create excitement or fear. Suddenly, the calm plan that once looked simple becomes difficult to follow. This is where the real challenge of investing begins. The market constantly tests the human mind. When prices rise quickly, people feel excitement and confidence. They believe the opportunity will disappear if they do not act immediately. This emotion is called greed. When prices fall suddenly, the opposite emotion appears. Fear spreads quickly. Investors begin to imagine endless losses and uncertain futures. This fear often forces them to sell at the worst possible moment. In reality, the market itself is not emotional. Companies continue producing products, serving customers, and earning profits. But the investors who trade those shares bring their emotions into the market every day. Benjamin Graham once explained this idea with a powerful observation. The investor's greatest problem and even his worst enemy is likely to be himself. This sentence reveals a deep truth about investing. The biggest danger is rarely the market. The biggest danger is the emotional reactions inside the investor mind. Warren Buffett also emphasized this idea when he said, "The most important quality for an investor is temperament, not intellect." Temperament means emotional balance. It means the ability to remain calm when others panic. It means the discipline to avoid excitement when markets become overly optimistic. Many investors lose money not because their ideas are wrong, but because their emotions push them to act at the wrong time. Imagine an investor who buys a strong company after careful research. For a while, everything seems fine. Then the market suddenly declines, prices fall, and negative news appears everywhere. If the investor allows fear to take control, they may sell the investment at a loss. Later, the market recovers and the company continues to grow, but the investor is no longer there to benefit from the recovery. The opposite situation also happens. A stock begins rising quickly. Friends, media, and social networks start talking about it. Everyone appears excited. The investor feels pressure to join the crowd. They buy at a very high price driven by excitement. Soon the excitement fades and the price falls. These patterns have repeated throughout financial history. The details of the market change, but human psychology remains remarkably similar. Successful investors understand this pattern and prepare themselves mentally. They accept that emotions will appear during investing. Instead of ignoring emotions, they learn to manage them. One useful approach is to slow down every important decision. When emotions feel strong, patience becomes extremely valuable. Waiting even a short time can help the mind return to a calmer state. Another approach is focusing on facts instead of feelings. Ask simple questions. Has the business itself changed? Has the long-term value changed? Or is the market simply reacting emotionally? Charlie Munger once said, "People calculate too much and think too little." Thinking clearly requires emotional distance. When investors step back and examine reality calmly, they often discover that the situation is less dramatic than it first appeared. Emotional control also improves long-term consistency. Investors who remain calm make fewer impulsive decisions. They follow their strategies more carefully. They avoid unnecessary trading and costly mistakes. Over time, this discipline creates a powerful advantage. The market will always move through cycles of optimism and pessimism. News will continue to create excitement and fear. But investors who learn to control their emotions develop a steady mindset that protects them from these waves. Mastering this first rule does not mean emotions disappear completely. It simply means emotions no longer control decisions. Once investors develop emotional balance, they gain the ability to wait patiently for the right opportunities. And patience, as many great investors have discovered, is one of the most powerful forces in building long-term wealth. This idea leads naturally to the next principle. The market rewards those who can wait calmly while others rush. The next rule explores this powerful advantage. Rule 2. Patience is a powerful investing skill. In the modern world, speed is celebrated everywhere. People expect quick results in business, technology, and personal success. Messages travel instantly. Information spreads within seconds. Because of this fast environment, many people expect investing to produce quick rewards as well. But the financial markets operate according to a very different rhythm. Wealth in investing is rarely created overnight. It is built slowly through patience, discipline, and time. Many new investors enter the market hoping for rapid gains. They watch prices every hour. They react to every news headline. They constantly buy and sell in search of quick profits. This behavior feels active and exciting, but it often produces disappointing results. The legendary investor Warren Buffett once explained this truth in a very simple sentence. The stock market is a device for transferring money from the impatient to the patient. This statement reveals one of the deepest lessons of investing. Impatience often destroys wealth, while patience quietly builds it. Markets move in cycles. Sometimes prices rise quickly. Sometimes they remain flat for long periods. Sometimes they decline sharply before recovering again. Investors who expect constant progress often become frustrated during slow periods. They abandon good investments too early and chase new opportunities that appear more exciting. But patient investors understand something important. Great businesses need time to grow. Strong companies expand their products, improve their services, and increase profits gradually. This process cannot be rushed. Charlie Munger once said, "The big money is not in the buying and the selling, but in the waiting." Waiting allows businesses to compound their earnings. Waiting allows markets to recognize true value. Waiting allows investors to benefit from the powerful force of compounding. Consider a simple example. A company grows its profits steadily year after year. At first, the progress may seem small, but over long periods, those steady improvements create extraordinary growth. Investors who remain patient during this journey often experience the greatest rewards. Patience also protects investors from emotional mistakes. When people rush to make decisions, they often ignore important details. They follow trends instead of analyzing value. They react to excitement instead of thinking calmly. By slowing down and waiting, investors create space for better judgment. The famous investor Peter Lynch once said, "Time is on your side when you own shares of superior companies." This idea highlights a powerful advantage. Time can work either against an investor or in favor of an investor. For impatient traders who constantly chase short-term movements, time often creates stress and confusion. But for patient investors who focus on strong businesses, time becomes a powerful ally. Patience also means accepting that markets will not always move according to personal expectations. Prices may fall temporarily, even when the long-term outlook remains strong. Economic conditions may create uncertainty. News events may cause temporary volatility. During these moments, patience becomes especially valuable. Instead of reacting emotionally, patient investors allow events to unfold and focus on long-term outcomes. History shows that many of the greatest investment successes came from long periods of quiet holding rather than constant trading. Businesses such as Coca-Cola, Apple, and many other successful companies rewarded investors who held their shares patiently through years of growth. Patience does not mean ignoring risks or avoiding research. It simply means giving investments the time they need to succeed. In a world that rewards speed, patience becomes a rare and powerful advantage. Investors who develop this skill gain something valuable. They are no longer pressured by every market movement. They do not chase excitement or panic during temporary declines. Instead, they allow time, discipline, and compounding to work together. But patience becomes much harder when everyone around you is doing the opposite. When crowds rush toward popular trends, the pressure to follow them becomes very strong. Understanding how crowds influence investor behavior is the next important step in mastering investor psychology. This leads to the next principle. Rule 3. Avoid the trap of herd mentality. Human beings are naturally social creatures. For thousands of years, survival depended on staying with the group. Following the crowd often meant safety. Moving alone meant danger. This instinct still lives inside the human mind today. It influences many decisions, including financial decisions. When people see many others buying a particular investment, they begin to feel more comfortable buying it as well. If everyone seems confident about a certain opportunity, it feels safe to follow the same path. But financial markets often turn this instinct into a dangerous trap. During strong market rallies, excitement spreads quickly. News channels celebrate rising prices. Friends and coworkers talk about profits. Social media becomes filled with stories of easy success. In these moments, investors feel pressure to join the crowd. They fear missing out on what appears to be a once-in-a-lifetime opportunity. This emotional pressure pushes many people to buy investments at very high prices. The opposite happens during market declines. Prices fall and negative headlines appear everywhere. Investors see others selling and begin to feel anxious. The crowd moves together in the direction of fear. Many people sell their investments simply because everyone else seems to be doing the same thing. This pattern has repeated throughout financial history. Sir John Templeton, one of the most respected investors in history, described this cycle clearly. Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. The final stage of euphoria is when herd mentality becomes strongest. People believe prices can only continue rising. Caution disappears and excitement dominates the market. Soon after, reality returns and prices fall sharply. Successful investors learn to observe the crowd without blindly following it. They understand that popularity does not guarantee value. Warren Buffett offered simple advice that reflects this mindset. Be fearful when others are greedy and greedy when others are fearful. This statement does not mean investors should automatically do the opposite of the crowd. Instead, it reminds them to remain independent in their thinking. Independent thinking requires patience and confidence. Sometimes it means waiting while others rush into popular trends. Sometimes it means staying calm when others panic. Benjamin Graham illustrated this idea through his famous story about Mr. Market. Mr. Market is an emotional partner who offers to buy or sell shares every day. Some days he is optimistic and offers very high prices. Other days he is depressed and offers very low prices. The intelligent investor does not allow Mr. Market emotions to control decisions. Instead, the investor uses those emotional price changes as opportunities. When investors free themselves from herd mentality, they gain an important advantage. They begin to focus on value rather than popularity. They examine businesses carefully instead of following trends. Independent thinking is not always comfortable. There may be moments when the crowd appears confident while the independent investor waits patiently. But over the long run, clear thinking often produces better results than emotional imitation. Once investors learn to step away from the influence of the crowd, they begin to see the market more clearly. They realize that prices and true value are not always the same thing. Understanding this difference is one of the most important ideas in intelligent investing. This leads directly to the next principle. Rule 4. Understand the difference between price and value. One of the most important lessons in investing is learning that price and value are not the same thing. Many people look at the market and assume that the current price of a stock represents its true worth. If the price rises, they believe the company has become more valuable. If the price falls, they assume something must be wrong. But markets do not always reflect reality in the short term. Prices move because of emotions, expectations, news, rumors, and speculation. True business value, however, changes much more slowly. A company becomes more valuable when it grows its earnings, improves its products, expands its customers, and strengthens its competitive position. These developments take time. They do not change every hour or every day. Because of this difference, market prices often move far above or far below the real value of a business. Benjamin Graham explained this idea through one of the most famous stories in the history of investing. He described the market as a partner named Mr. Market. Every day, Mr. Market comes to you with an offer. Sometimes he is extremely optimistic and offers to buy your shares at very high prices. Other times, he becomes depressed and offers to sell shares at very low prices. The important lesson is that you are not required to follow his mood. You are free to ignore his offers whenever they seem unreasonable. In this story, Mr. Market represents the emotional nature of financial markets. Some days the crowd becomes overly excited and pushes prices far above the real value of companies. Other days, fear spreads and prices fall far below reasonable levels. Intelligent investors understand that these emotional swings create opportunities. Warren Buffett often repeats a simple but powerful principle. Price is what you pay. Value is what you get. This sentence captures the heart of value investing. Imagine two investors looking at the same company. One investor focuses only on the recent price movement. If the price is rising quickly, this investor assumes the company must be a good investment. The other investor studies the business itself. They examine the company profits, management quality, products, and long-term growth potential. Instead of chasing price movements, they try to estimate the true value of the company. These two approaches often lead to very different decisions. When prices become extremely high because of excitement, value-focused investors become cautious. They understand that paying too much for even a great company can lead to disappointing results. When prices fall because of temporary fear or negative news, value-focused investors become interested. They recognize that a strong business selling at a low price may offer a good opportunity. This approach requires patience and discipline. It also requires the ability to think independently. The famous investor Seth Klarman once explained this mindset clearly. Successful investors tend to be unemotional, allowing them to take advantage of the mistakes of others. When crowds react emotionally, prices can become disconnected from value. Calm investors who understand this difference can use those moments wisely. Another important idea related to value is the concept of margin of safety. Benjamin Graham believed investors should buy assets at prices significantly below their estimated value. This difference between price and value creates a safety cushion. If unexpected problems occur, the margin of safety reduces the risk of large losses. For example, imagine a business that appears to be worth 100 units of value. If an investor buys it for a much lower price, there is room for error in the analysis. Even if the estimate of value is slightly wrong, the investment may still be safe. This principle protects investors from the uncertainty that always exists in markets. Understanding price and value also changes the way investors react to market volatility. Instead of fearing falling prices, value-oriented investors often see them as opportunities. If a strong company becomes temporarily cheaper, the investment may become more attractive. This mindset transforms market fluctuations from a source of stress into a source of potential advantage. However, this approach requires emotional discipline. When prices fall quickly, the crowd becomes fearful. Remaining calm during these moments is not easy. This is why investor psychology is so important. The ability to distinguish between price and value allows investors to avoid many common mistakes. They no longer chase excitement during market booms. They no longer panic during temporary declines. Instead, they focus on the underlying strength of businesses and the long-term potential of their investments. Over time, this disciplined approach often leads to better decisions and more stable results. But recognizing value alone is not enough. Investors must also give their investments enough time to succeed. Markets may take months or even years to recognize the true value of a company. Without patience, even a correct investment idea may fail to produce results. This important idea leads naturally to the next principle. Rule 5. Long-term thinking creates clarity. One of the greatest advantages an investor can develop is the ability to think long-term. Financial markets often appear chaotic when viewed over short periods. Prices move every day. News headlines appear every hour. Experts constantly predict what might happen next. When investors focus only on these short-term movements, the market begins to look confusing and unpredictable. Emotions become stronger because every small change feels important. But when the same market is viewed over longer periods, a different picture appears. Temporary noise fades away. The real progress of businesses becomes visible. Companies that create value for customers tend to grow over time. Long-term thinking helps investors see this bigger picture. In the short term, prices are often influenced by speculation, rumors, and emotional reactions. In the long term, however, the strength of the business itself becomes the most important factor. Benjamin Graham explained this idea with a simple observation. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. The voting machine represents popularity and emotion. Investors vote for what they believe is exciting at the moment. Prices move according to those temporary opinions. The weighing machine represents reality. Over time, businesses are weighed by their earnings, growth, and long-term performance. Strong companies eventually reflect their true value. Investors who understand this difference learn to ignore much of the short-term noise that surrounds the market. The legendary investor Peter Lynch once said, "The key to making money in stocks is not to get scared out of them." This idea highlights an important psychological challenge. Many investors begin with good long-term investments but abandon them too early. Short-term volatility creates fear and uncertainty. Instead of waiting for the long-term story to unfold, they sell during temporary declines. Later, the same companies recover and continue growing, but the impatient investor is no longer there to benefit. Long-term thinking protects investors from this cycle. It allows them to focus on the progress of the business rather than daily price movements. Warren Buffett is well known for his long-term perspective. He once explained his philosophy in a very simple way. Our favorite holding period is forever. This statement does not mean every investment must be held permanently. It simply reflects a mindset that values patience and long-term growth. When investors adopt this perspective, many market events become less stressful. Daily price fluctuations lose their importance. Temporary market declines become easier to tolerate. Instead of reacting emotionally, investors concentrate on important questions. Is the business still strong? Is the company continuing to serve customers and grow its profits? Has the long-term story changed? If the answers remain positive, short-term volatility becomes less concerning. Long-term thinking also allows the power of compounding to work effectively. Compounding is the process where earnings generate additional earnings over time. At first, the progress may appear small, but as years pass, the growth begins to accelerate. This gradual expansion can transform modest investments into substantial wealth. However, compounding requires time. Frequent trading interrupts this process. Each time an investor jumps from one opportunity to another, the compounding journey begins again from the beginning. Patient investors who allow their investments to grow quietly often experience the greatest benefits of compounding. Long-term thinking also improves decision-making. When investors focus on distant outcomes rather than immediate reactions, they tend to evaluate opportunities more carefully. They examine business models, they study management quality, they analyze long-term trends that may influence the future of the company. This deeper analysis often leads to stronger and more thoughtful investment decisions. Of course, long-term thinking does not mean ignoring risks or refusing to adapt. Markets change. Industries evolve. Technology transforms the competitive landscape. Investors must remain aware of these developments and adjust their understanding when necessary. But the key idea remains the same. Successful investing is not a race measured in days or weeks. It is a long journey measured in years and sometimes decades. Those who develop a long-term mindset often experience greater clarity. They are less distracted by temporary market noise. They remain focused on the true drivers of wealth creation. However, even long-term investors must accept an important truth about financial markets. The future can never be predicted with complete certainty. Unexpected events will always appear. Economic conditions will change. New challenges will emerge that no one can fully anticipate. Learning how to live with this uncertainty is the next essential step in mastering investor psychology. This leads to the next principle. Rule 6. Accept uncertainty as part of investing. One of the most difficult ideas for investors to accept is uncertainty. People naturally want clear answers about the future. They want to know which companies will succeed, which investments will fail, and how markets will behave in the coming years. But financial markets do not offer perfect certainty. The future is always influenced by many changing forces. Economic conditions evolve. Technology transforms industries. Political events reshape global markets. Unexpected crises appear without warning. Because of these realities, no investor can predict the future with complete accuracy. Many beginners struggle with this truth. They search for experts who claim to know exactly what will happen next. They follow forecasts that promise clear answers about future market movements. For a short time, these predictions may appear convincing, but over longer periods, it becomes clear that markets are far more complex than any single forecast. The economist John Kenneth Galbraith once said, "The only function of economic forecasting is to make astrology look respectable." This statement may sound humorous, but it reflects an important lesson. Forecasting the exact direction of markets is extremely difficult. Successful investors do not depend on perfect predictions. Instead, they build strategies that work even when the future is uncertain. One way to manage uncertainty is through diversification. Diversification means spreading investments across different companies, industries, and sometimes different countries. When investors place all their capital into a single opportunity, their entire future depends on one outcome. If that investment fails, the financial damage can be severe. But when investments are spread across several opportunities, the risk becomes more balanced. A problem in one area may be offset by success in another. Diversification does not eliminate risk completely, but it reduces the impact of unexpected events. Another way to handle uncertainty is by focusing on strong businesses rather than short-term predictions. Companies with durable advantages, capable management, and loyal customers often adapt successfully to changing environments. Even when challenges appear, strong businesses usually find ways to recover and continue growing. Warren Buffett has often emphasized the importance of investing in businesses that can survive uncertainty. He once explained that he prefers companies so strong that even if they are managed imperfectly, they can still succeed. This approach recognizes that the future will always contain surprises. Instead of trying to eliminate uncertainty, wise investors prepare for it. Accepting uncertainty also improves emotional stability. When investors believe they must predict everything correctly, every unexpected event becomes stressful. Market declines feel like personal failures. But when investors accept that uncertainty is normal, they become more resilient. They understand that temporary setbacks are part of the investing journey. Howard Marks once described the importance of this mindset clearly. You cannot predict the future, but you can prepare for it. Preparation may include maintaining cash reserves, diversifying investments, and avoiding excessive risk. These steps help investors remain stable even when markets become unpredictable. Another valuable habit is humility. Investors who recognize the limits of their knowledge are often more careful in their decisions. They avoid placing too much confidence in any single prediction or strategy. This humility protects them from one of the most dangerous psychological traps in investing. When people experience early success, they sometimes begin to believe they have special insight into the market. They assume their judgments are always correct and their predictions will always succeed. This dangerous belief is known as overconfidence. Overconfidence can lead investors to take excessive risks, ignore warning signs, and concentrate too much money in a single idea. Many financial disasters in history were caused not by ignorance but by excessive confidence. Understanding how overconfidence develops and learning how to avoid it becomes another crucial step in mastering investor psychology. This leads naturally to the next principle. Rule 7. Avoid overconfidence. Confidence is necessary for investing. Without confidence, an investor would never make decisions or commit capital. But there is a subtle difference between healthy confidence and dangerous overconfidence. Healthy confidence is based on careful study, patience, and awareness of risk. Overconfidence appears when investors begin to believe they cannot be wrong. This psychological shift is one of the most common causes of investment mistakes. Many investors experience a period of early success. They make a few profitable investments and begin to feel they understand the market better than others. They start to believe their judgment is always correct. At first, this confidence feels empowering, but slowly it begins to influence their decisions in dangerous ways. Overconfident investors often take larger risks. They invest more money in a single idea. They ignore warnings that might challenge their opinions. They trade more frequently, believing they can predict market movements. This behavior creates vulnerability. The famous investor Warren Buffett once said something very important about the nature of markets. Risk comes from not knowing what you are doing. Overconfidence makes investors believe they know more than they actually do. This illusion can lead to costly mistakes. Financial history offers many examples of this pattern. Periods of rising markets often create widespread confidence. Investors experience gains and begin to believe their success comes from skill rather than favorable conditions. During these times, people borrow money to invest. They place large bets on popular trends. They assume the market will continue rising indefinitely. Eventually, reality returns. Markets slow down or decline. Those who took excessive risks discovered that their confidence was not supported by careful judgment. The investor. Howard Marks once explained this psychological trap clearly. The biggest investing errors come not from factors that are informational or analytical, but from those that are psychological. Overconfidence is one of the most powerful psychological errors. Successful investors protect themselves by maintaining humility. Humility does not mean doubting every decision. It means recognizing that markets are complex and unpredictable. Even the most experienced investors make mistakes. Ray Dalio, founder of one of the largest investment firms in the world, once shared an important insight. He said that pain plus reflection equals progress. This idea highlights the value of learning from mistakes. Instead of denying errors, wise investors examine them carefully. They ask what assumptions were wrong and how they can improve future decisions. Humility also encourages careful risk management. Investors who respect uncertainty avoid placing all their capital into a single opportunity. They diversify their investments and maintain safety margins. Another useful habit is questioning personal assumptions. When investors feel extremely certain about an idea, it can be helpful to ask difficult questions. What if the analysis is incomplete? What risks might have been ignored? What evidence challenges this belief? This process helps prevent confidence from becoming excessive. Charlie Munger often emphasizes the importance of intellectual humility. He once said that the best protection against mistakes is constantly reminding yourself that you might be wrong. This mindset encourages investors to remain curious and open to new information. Overconfidence also encourages excessive activity in the market. Many investors believe they must constantly trade in order to succeed. They watch price movements closely and react to every opportunity they believe they see. But constant activity rarely produces consistent results. Frequent trading increases costs, taxes, and emotional stress. Warren Buffett once described his approach with a calm perspective. He explained that successful investing does not require extraordinary intelligence, but it does require the ability to ignore unnecessary action. This philosophy reflects patience and discipline rather than constant confidence in prediction. Avoiding overconfidence allows investors to remain balanced. They make decisions carefully and remain prepared for unexpected outcomes. They understand that markets are influenced by many forces beyond individual control. Instead of believing they can predict everything, they focus on building strong processes and managing risk wisely. Humility becomes a quiet strength that protects them from dangerous mistakes. But even careful investors will sometimes experience losses and poor decisions. No strategy works perfectly every time. No investor avoids mistakes completely. The key difference between successful investors and unsuccessful ones is not the absence of mistakes. The difference lies in how those mistakes are understood and used as lessons. Learning to face errors calmly and extract wisdom from them is the next important step in mastering investor psychology. This leads to the next principle. Rule 8. Learn from mistakes without emotional regret. Every investor, no matter how experienced or intelligent, will eventually make mistakes. Some investments will fail. Some decisions will lead to losses. Some opportunities will be missed. This is not a sign of failure. It is a natural part of the investing journey. The financial markets are complex and uncertain. Even the greatest investors in history have experienced difficult periods and costly errors. Warren Buffett once admitted that some of his investment decisions caused significant losses. Yet those mistakes did not define his career. What mattered was his ability to learn from them and improve his judgment over time. The real danger is not making mistakes. The real danger is reacting to mistakes in the wrong way. Many investors respond to losses with strong emotions. They feel regret, frustration, or embarrassment. These emotions often lead to two harmful reactions. The first reaction is denial. An investor refuses to admit the mistake and continues holding a poor investment, hoping the situation will improve. The second reaction is excessive regret. An investor becomes discouraged and loses confidence in future decisions. Both reactions prevent learning. Wise investors approach mistakes differently. They treat each error as a source of information. Ray Dalio once explained this principle clearly. Pain plus reflection equals progress. Losses create emotional pain, but reflection transforms that pain into knowledge. After a mistake occurs, thoughtful investors ask themselves important questions. What assumption was incorrect? Did the analysis overlook a key factor? Was the decision influenced by emotion or crowd pressure? By examining these questions calmly, investors turn mistakes into valuable lessons. Another important idea is separating identity from outcomes. Some investors believe a losing investment means they are personally unsuccessful. This emotional connection makes it difficult to admit errors. But investments are decisions, not identities. A single mistake does not define an investor ability or intelligence. Charlie Munger once said something very useful about this topic. If you do not learn from your mistakes, you are doomed to repeat them. This simple truth highlights the importance of reflection. Successful investors often keep records of their decisions. They write down why they made a particular investment and what expectations they had at the time. Later, they review those notes and compare the outcome with the original reasoning. This practice reveals patterns in thinking. It helps investors identify repeated mistakes, such as emotional reactions, incomplete research, or excessive optimism. Over time, this process strengthens judgment and improves decision-making. Another valuable habit is maintaining emotional balance after losses. When investors experience a loss, the temptation to react quickly can be strong. Some people immediately search for another investment in an attempt to recover the loss. Others abandon their strategy completely and chase new ideas. These reactions often create additional mistakes. A better approach is to pause and reflect, allow time for emotions to settle. Review the situation calmly before making new decisions. The legendary investor Howard Marks once explained an important principle. Experience is what you got when you did not get what you wanted. Losses often become the experiences that shape future wisdom. Investors who learn from mistakes gradually build stronger mental discipline. They become more careful in their research. They recognize emotional traps more easily. They improve their ability to evaluate risk. Over many years, this accumulated learning becomes a powerful advantage. Another important lesson from mistakes is understanding that short-term outcomes do not always reflect decision quality. Sometimes a well-researched investment may still produce a loss because of unexpected events. At other times, a poorly considered decision may produce a temporary profit. Judging decisions only by short-term results can therefore be misleading. Instead, investors should evaluate whether their process was sound. Did they study the business carefully? Did they consider risks thoughtfully? Did they avoid emotional pressure? If the process was strong, the decision may still be valuable even if the short-term outcome was disappointing. Focusing on the quality of decisions rather than immediate results helps investors develop a more stable mindset. Over time, this approach leads to better consistency and stronger long-term performance. Mistakes then become stepping stones instead of obstacles. But learning from mistakes also requires another important shift in thinking. Investors must stop focusing only on short-term results and begin focusing on the quality of their decision-making process. This deeper focus helps them build discipline and consistency over time. Understanding the difference between results and process leads to the next important principle in mastering investor psychology. Rule 9. Focus on process instead of short-term results. Many investors judge their decisions only by the immediate outcome. If an investment produces a quick profit, they believe the decision was correct. If it produces a loss, they assume the decision was wrong. At first, this way of thinking appears reasonable. After all, profit seems like success and loss seems like failure. But in investing, this logic can be misleading. Markets are influenced by many factors that cannot be predicted with certainty. Unexpected news, economic changes, political events, and emotional reactions from other investors can move prices suddenly. Because of this uncertainty, even a carefully researched investment can produce a temporary loss. At the same time, a poorly considered investment might produce a short-term gain simply because the market moved in a favorable direction. This is why experienced investors focus less on short-term results and more on the quality of their decision-making process. A strong investment process includes careful research, thoughtful analysis, and disciplined risk management. It requires patience and emotional control. It encourages investors to follow clear principles rather than reacting to market noise. When investors follow a sound process, their decisions are guided by logic rather than impulse. Over time, this disciplined approach tends to produce better results than decisions based only on excitement or fear. The legendary investor Warren Buffett once explained an important idea related to this principle. You do not have to swing at every pitch. You can wait for the right opportunity. This mindset reflects a process-based approach. Instead of reacting to every market movement, investors wait for situations that meet their criteria. Focusing on process also helps investors remain calm during periods of volatility. If a temporary loss occurs, they review their reasoning rather than reacting emotionally. They ask themselves important questions. Was the original analysis thoughtful and thorough? Has the underlying business changed? Were the risks understood before the decision was made? If the process was sound, the temporary result may simply be part of normal market fluctuations. Benjamin Graham described the importance of discipline in decision-making through the concept of rational investing. He believed investors should rely on careful analysis rather than emotional reactions to market movements. This idea reinforces the importance of process over outcome. Another benefit of focusing on process is consistency. Investors who make decisions based on emotions often change their strategies frequently. They follow trends during rising markets and abandon them during declines. This constant switching creates confusion and instability. A clear process provides stability. It acts like a guide that helps investors navigate uncertain markets. Even when conditions become challenging, the process reminds investors of their principles and long-term goals. Ray Dalio often emphasizes the importance of systems and principles in decision-making. He believes that clear processes help individuals and organizations make better choices over time. A well-designed investment process may include several steps: careful study of businesses and industries, evaluation of financial strength and long-term growth potential, consideration of risks and possible uncertainties, determination of a reasonable purchase price. These steps encourage thoughtful decisions rather than impulsive reactions. Another advantage of process thinking is that it encourages continuous improvement. After each investment decision, investors can review what happened and refine their approach. They can identify areas where their analysis was strong and areas where it may have been incomplete. This gradual improvement strengthens their judgment over time. By contrast, investors who focus only on results often miss these opportunities to learn. If a decision produces a profit, they may assume everything was done correctly even if the reasoning was weak. If a loss occurs, they may abandon a good strategy prematurely. Process thinking creates a more balanced perspective. It reminds investors that long-term success is built from many decisions made over many years. Not every decision will succeed, but consistent discipline increases the probability of positive outcomes over time. This mindset also reduces emotional stress. Instead of worrying about every short-term price movement, investors concentrate on following their principles. They understand that results will eventually reflect the quality of their process. However, even the best process cannot eliminate all risk. Markets will always involve uncertainty and occasional losses. Because of this reality, wise investors place great importance on protecting their capital before seeking large profits. Protecting what you already have is the foundation of long-term financial success. This essential idea leads to the next principle. Rule 10. Protect capital first. In investing, many people focus only on one goal. They want to make as much money as possible. They search for opportunities that promise large profits and rapid growth. While the desire for profit is natural, experienced investors understand a deeper principle. The first responsibility of an investor is not to make money. The first responsibility is to protect the capital they already have. Without protection, wealth cannot survive long enough to grow. Losses have a powerful impact on investment results. When capital declines significantly, recovering from that loss becomes much more difficult. For example, if an investment loses half of its value, the remaining capital must double simply to return to its original level. This reality shows why avoiding large losses is so important. The legendary investor Warren Buffett expressed this idea through two famous rules. Rule 1, never lose money. Rule 2, never forget Rule 1. These words may sound simple, but they contain profound wisdom. Of course, every investor will experience occasional losses. The goal is not to avoid every loss completely. The goal is to avoid large and permanent losses that destroy capital. Protecting capital requires discipline and thoughtful risk management. One important tool for protection is the margin of safety. Benjamin Graham introduced this concept to help investors reduce risk. The margin of safety means purchasing investments at prices significantly below their estimated value. When an investor pays too high a price, even a good company may produce disappointing returns. But when an investment is purchased at a reasonable or discounted price, the risk becomes smaller. The margin of safety acts like a protective cushion. It allows room for unexpected problems or errors in judgment. Another important method of protecting capital is diversification. Placing all money into a single investment may create the possibility of large gains, but it also creates the possibility of devastating losses. Diversification spreads investments across different companies and industries. If one investment performs poorly, others may perform better and balance the overall result. Diversification does not guarantee profit, but it reduces the impact of unexpected events. Wise investors also avoid excessive risk. Some opportunities promise extraordinary returns but require taking large risks. These situations may appear attractive at first, especially when others seem to be making quick profits. However, investments that depend on extreme optimism or heavy borrowing often carry hidden dangers. Charlie Munger once warned about the dangers of reckless behavior in financial markets. He explained that avoiding stupidity is often more important than chasing brilliance. This perspective encourages investors to remain cautious. Instead of searching for dramatic opportunities, they focus on steady and sustainable growth. Protecting capital also means understanding personal limits. Some investors feel pressure to follow complex strategies they do not fully understand. Others imitate professional traders who operate with very different resources and experience. But intelligent investors remain within their circle of competence. They choose investments they understand and avoid areas that appear confusing or uncertain. Warren Buffett frequently emphasizes this principle. He believes investors do not need to understand every opportunity in the market. They only need to recognize a few good opportunities within areas they understand well. Another important habit is maintaining patience during uncertain times. When markets become volatile, fear and excitement can push investors toward risky decisions. Some people rush into speculative investments hoping for quick recovery. Others sell strong investments simply to escape temporary losses. Both reactions can damage capital. Calm and disciplined investors understand that protecting capital sometimes means doing nothing. They wait patiently until conditions become clearer or better opportunities appear. This patience preserves resources and prevents unnecessary losses. Protecting capital also creates a strong foundation for long-term growth. When investors avoid major losses, their portfolios remain stable enough to benefit from future opportunities. They maintain the financial strength needed to invest when attractive opportunities appear. Over many years, this careful protection allows wealth to compound steadily. The goal of investing is not to win every battle. The goal is to survive and prosper over the entire journey. Investors who protect their capital develop resilience. They remain prepared for both opportunities and challenges that appear in financial markets. But protecting capital requires another important habit. Many investors become too focused on watching market prices every moment. They monitor every movement and react emotionally to small fluctuations. This constant attention can create stress and encourage impulsive decisions. Understanding how to step back from this habit and maintain calm focus is the next important step in mastering investor psychology. This leads to the next principle. Rule 11. Avoid constant market watching. Modern technology has made financial markets available every moment of the day. Investors can open an application on their phone and instantly see price movements from around the world. Charts update every second. News alerts appear constantly. Market discussions continue without pause. At first, this easy access seems useful. Information is important, and the ability to observe markets quickly can help investors stay informed. But constant market watching often creates a hidden psychological problem. When investors observe price changes every minute, small movements begin to feel very important. A tiny decline may create worry. A sudden increase may create excitement. These emotional reactions can lead to impulsive decisions. Instead of focusing on the long-term strength of businesses, investors become distracted by short-term fluctuations. They buy when prices rise quickly because excitement spreads through the market. They sell when prices fall because fear appears suddenly. In reality, many of these small price changes have little meaning for long-term investors. A strong business does not change its value every hour. Its products, customers, and profits evolve slowly over time. But when investors watch markets constantly, the illusion of urgency appears. Every movement feels like a signal that demands immediate action. The legendary investor Peter Lynch once shared an important observation. He said that if investors spend more than a few minutes each year thinking about market predictions, they are probably wasting their time. His message was simple. Constant attention to market movements rarely improves investment results. Warren Buffett follows a similar philosophy. He does not attempt to predict daily or weekly price changes. Instead, he focuses on understanding businesses and their long-term potential. This calm approach allows investors to remain emotionally stable. Imagine two investors. The first investor checks market prices every few minutes. Each small decline creates anxiety. Each rise creates excitement. Because of these emotional swings, this investor frequently buys and sells investments. The second investor studies companies carefully and then holds them patiently. Instead of watching every movement, this investor reviews the business occasionally and focuses on long-term progress. Over time, the second investor usually experiences less stress and better discipline. Constant market watching also increases the temptation to trade frequently. Frequent trading often produces higher transaction costs and taxes. It also increases the chance of emotional mistakes. Benjamin Graham once reminded investors that the market exists to serve them, not to guide them. Its purpose is to offer opportunities, not to demand constant attention. When investors understand this principle, they stop treating every price movement as a signal. Instead, they view market prices as occasional opportunities to buy or sell when conditions are favorable. Another benefit of reducing market watching is improved mental clarity. When the mind is not constantly reacting to price changes, it becomes easier to think calmly about long-term decisions. Investors can spend their time studying businesses, learning about industries, and refining their strategies. This thoughtful work often produces better results than constant monitoring. Howard Marks once explained that successful investing is often about resisting the urge to act. Many investors believe activity equals progress. But in financial markets, patience and restraint often create better outcomes. Reducing the habit of constant market watching encourages this restraint. Investors who check prices less frequently usually experience fewer emotional reactions. They become less influenced by temporary market moods. Instead, they focus on the qualities that truly matter: strong businesses, sound strategies, long-term growth. Over time, this mindset helps investors develop greater discipline and stability. The market continues to move every day, but the investor no longer feels the need to react to every movement. Once investors free themselves from the habit of constant monitoring, another important insight becomes clear. Many successful investment strategies are surprisingly simple. They do not require endless calculations or complicated systems. Understanding the power of simplicity becomes the next important step in mastering investor psychology. This leads to the next principle, Rule 12. Simplicity often beats complexity. Many people believe successful investing must be complicated. They imagine that the best investors use complex formulas, advanced mathematics, and secret strategies that ordinary people cannot understand. Financial markets often encourage this belief. There are countless indicators, charts, forecasts, and analytical models that promise to reveal hidden patterns in market behavior. While analysis can be useful, complexity does not always lead to better decisions. In many cases, complicated strategies create confusion rather than clarity. The famous scientist Albert Einstein once said, "Everything should be made as simple as possible, but not simpler." This idea applies strongly to investing. Successful investors often rely on a few clear principles rather than complicated systems. They focus on understanding businesses, evaluating value, and maintaining discipline. Warren Buffett is one of the best examples of this philosophy. Despite managing enormous amounts of capital, his approach to investing is remarkably simple. He studies businesses carefully. He looks for companies with strong competitive advantages. He waits until the price offers reasonable value. Then he holds those investments patiently for long periods. This method does not depend on predicting short-term market movements. It does not require constant trading or complicated calculations. Instead, it relies on patience, rational thinking, and a clear understanding of value. Charlie Munger once explained that simple ideas, when applied consistently, can produce extraordinary results. He often warns investors about the dangers of unnecessary complexity. When strategies become too complicated, it becomes difficult to understand the risks involved. Complex systems can create the illusion of control. Investors may believe they have discovered a method that guarantees success, but markets rarely behave according to perfectly designed formulas. Simple strategies are often easier to understand and easier to follow with discipline. For example, many successful investors follow a few basic habits. They invest regularly, they diversify their portfolios, they focus on strong businesses or broad market funds. They avoid emotional decisions. These habits may appear ordinary, but over long periods, they can produce powerful results. Simplicity also helps investors remain calm during uncertain markets. When strategies are complicated, investors may struggle to understand why an investment is rising or falling. This uncertainty can lead to doubt and emotional reactions. But when an investment approach is simple and clear, it becomes easier to stay confident during temporary volatility. Peter Lynch once explained that investors should never invest in a company they cannot explain in a few simple sentences. This advice encourages clarity and understanding. If an investment idea cannot be explained simply, it may indicate that the risks or assumptions are not fully understood. Simplicity also reduces the temptation to trade constantly. Complex strategies often require frequent adjustments and monitoring. This constant activity increases costs and emotional pressure. Simple strategies allow investors to focus on long-term progress rather than short-term movements. They create space for patience and discipline. Another benefit of simplicity is that it encourages consistent behavior. When rules are clear and easy to remember, investors are more likely to follow them even during stressful market conditions. Complicated rules are easier to abandon when emotions become strong. By keeping their strategies simple, investors strengthen their ability to remain disciplined. Over time, this discipline becomes one of the most valuable advantages in financial markets. However, even a simple strategy can feel stressful if all investments are concentrated in one place. Large concentration can create emotional pressure whenever prices move sharply. Learning how to spread investments wisely helps reduce this pressure and creates greater stability. This important idea leads to the next principle. Rule 13. Diversification reduces psychological pressure. Investing always involves uncertainty. No matter how carefully an investor studies a company or analyzes an opportunity, the future can never be predicted with complete certainty. Because of this uncertainty, placing all money into a single investment can create both financial risk and psychological pressure. When an investor depends on only one or two investments, every price movement begins to feel extremely important. A small decline may cause worry. A larger decline may create fear and panic. This emotional pressure often leads to poor decisions. Investors may sell too quickly during temporary declines or make impulsive changes to their strategy. Diversification helps reduce this pressure. Diversification means spreading investments across different companies, industries, or types of assets. Instead of relying on one opportunity, the investor builds a collection of investments that work together. If one investment performs poorly, others may perform better and balance the overall result. The purpose of diversification is not to eliminate risk completely. Risk will always exist in financial markets. The purpose is to prevent a single mistake or unexpected event from causing serious damage. The economist Harry Markowitz, who studied portfolio theory, once explained diversification with a simple idea. He said diversification is the only free lunch in investing. His statement meant that spreading investments wisely can reduce risk without necessarily reducing long-term returns. But diversification also provides an important psychological benefit. When investors hold a balanced portfolio, they experience less emotional stress. A decline in one investment does not threaten their entire financial future. This stability helps investors remain calm during market volatility. Imagine two investors again. The first investor places all money into one company. Every piece of news about that company creates intense emotional reactions. If the price falls sharply, panic appears quickly because everything depends on that single decision. The second investor spreads investments across several strong companies and industries. When one investment experiences difficulty, The overall portfolio remains stable. Because the risk is balanced, the second investor can think more clearly and avoid emotional reactions. Diversification therefore protects both capital and psychological stability. However, diversification should still be thoughtful. Owning too many investments without understanding them can also create confusion. Warren Buffett once explained that diversification is protection against ignorance. He meant that investors who are not deeply familiar with individual companies benefit from spreading their investments more widely. At the same time, thoughtful investors try to understand the businesses they own. Diversification works best when it combines balance with knowledge. Another advantage of diversification is resilience during unexpected events. Economic cycles, technological changes, and global events can affect industries differently. A balanced portfolio allows investors to adapt to these changes more easily. For example, if one industry experiences a temporary decline, another industry may continue growing. This balance provides stability over long periods. Diversification also encourages patience. When investors know that their portfolio is balanced and resilient, they feel less pressure to react to every market movement. They become more comfortable allowing time and compounding to work. Over years and decades, this calm approach often leads to better results. In investing, emotional stability is just as important as financial strategy. Diversification supports both. It protects the portfolio from severe damage and helps the investor remain calm during uncertain markets. Once investors reduce psychological pressure through diversification, another important challenge appears. Even with a balanced portfolio, emotions can still influence decisions during market excitement or fear. Learning how to recognize and control these emotional reactions becomes the next step in mastering investor psychology. This leads to the next principle. Rule 14. Ignore short-term noise. Financial markets produce an enormous amount of information every day. News channels discuss market movements constantly. Analysts share predictions about the next rise or fall. Social media spreads opinions and rumors at incredible speed. At first, this information appears useful. Investors naturally believe that more information will help them make better decisions. But in reality, much of this information is short-term noise. Short-term noise consists of opinions, temporary events, emotional reactions, and speculation that have little influence on long-term value. Markets react to countless small events every day. A news headline appears. An analyst changes a forecast. A rumor spreads among traders. Prices may move quickly because of these events, but the underlying strength of businesses usually remains unchanged. When investors pay too much attention to this noise, they begin to feel constant pressure to act. They believe every headline requires a response. They buy because of excitement and sell because of fear. This behavior often leads to frequent trading and emotional mistakes. Warren Buffett once shared an idea that reflects this principle clearly. He said that if the market closed for many years after he made an investment, he would still be comfortable holding strong businesses. This statement shows how little importance he places on daily market fluctuations. Benjamin Graham also explained that the market should be viewed as a servant, not a guide. Its daily price changes are simply offers, not instructions. Investors are free to accept or ignore those offers. Successful investors therefore learn to filter information carefully. They focus on information that truly matters for long-term value. This includes business performance, management quality, industry trends, and financial strength. These factors shape the future of companies far more than daily headlines. Peter Lynch once offered simple advice to investors. He said that many investors spend more time worrying about market corrections than they do understanding the businesses they own. This habit can lead to unnecessary stress. When investors constantly watch news and predictions, their emotions become tied to every market movement. A negative headline may create anxiety even if it has little impact on the long-term prospects of an investment. By ignoring short-term noise, investors protect their mental clarity. They focus on what truly matters. They study businesses instead of chasing headlines. They think about long-term growth instead of daily volatility. This mindset encourages patience and discipline. Howard Marks once explained that successful investors must develop the ability to resist popular narratives. Crowds often become excited or fearful based on recent news. but wise investors step back and examine the bigger picture. Another benefit of ignoring short-term noise is improved emotional stability. When investors stop reacting to every headline, the market becomes less stressful. Price fluctuations appear as normal movements rather than urgent signals. This calm perspective allows investors to make thoughtful decisions rather than impulsive ones. Of course, important information should never be ignored. Major changes in a company business model, financial health, or industry environment deserve careful attention. The challenge is learning to distinguish meaningful information from temporary noise. With practice, investors develop this ability. They begin to see that many headlines simply reflect short-term market emotions rather than lasting changes in value. Once investors reduce the influence of noise, they can focus on building strong habits that support disciplined investing. These habits guide behavior during both calm and turbulent markets. Developing these habits becomes the next important step in mastering investor psychology. This leads to the next principle, Rule 15. Build habits that support discipline. Successful investing is not the result of one brilliant decision. It is the result of many small decisions repeated consistently over long periods of time. Because of this, habits play a powerful role in the life of an investor. A habit is a behavior that becomes automatic through repetition. Once a habit is formed, it requires less effort to maintain. Good habits guide decisions even when emotions become strong. In financial markets, emotions often change quickly. Excitement appears during rising markets. Fear spreads during market declines. Without strong habits, investors may react to these emotional waves and abandon their long-term strategies. Disciplined habits help prevent this reaction. For example, one of the most important habits for investors is regular saving and investing. Instead of waiting for the perfect moment, disciplined investors invest consistently over time. This habit removes the pressure of trying to predict short-term market movements. Another valuable habit is continuous learning. Successful investors read books, study business models, and observe economic trends. They treat investing as a lifelong journey of knowledge and improvement. The legendary investor Charlie Munger often emphasizes the importance of constant learning. He once said that the best way to become wiser is to learn something new every day. This mindset helps investors refine their judgment and avoid repeating mistakes. Another important habit is emotional discipline. Investors who develop emotional awareness recognize when fear or excitement begins to influence their thinking. Instead of reacting immediately, they pause and evaluate the situation calmly. This simple habit prevents many costly mistakes. Warren Buffett often demonstrates this type of discipline. He is known for remaining calm during both market booms and market crashes. His behavior shows that disciplined habits are stronger than temporary emotions. Keeping written notes about investment decisions is another useful habit. Some investors maintain a journal where they record why they purchased a particular investment. They write down their expectations, assumptions, and concerns. Later, they review these notes and compare them with actual outcomes. This habit improves self-awareness and helps investors learn from experience. Patience is also a habit that develops over time. Many people believe patience is a natural personality trait, but it can also be trained. Investors who repeatedly practice waiting for good opportunities gradually become more comfortable with patience. Over time, waiting becomes easier and more natural. Another helpful habit is avoiding unnecessary distractions. Constant news updates and endless market predictions can overwhelm the mind. Disciplined investors limit their exposure to these distractions and focus on meaningful information instead. Howard Marks once explained that successful investors are often distinguished by their ability to control their own behavior. This control is strengthened through consistent habits. Habits also reduce decision fatigue. When investors follow clear routines, they do not need to reconsider every small decision from the beginning. Their habits guide them toward rational actions. Over many years, these disciplined behaviors accumulate powerful benefits. Regular investing builds financial momentum. Continuous learning strengthens judgment. Emotional control protects investors from impulsive mistakes. Together, these habits create a strong foundation for long-term success. But disciplined habits alone are not enough to build wealth. investors must also understand one of the most powerful forces in finance. This force quietly transforms small and consistent gains into significant long-term growth. Understanding this force changes the entire perspective of investing. This leads to the next principle. Rule 16. Respect the power of compounding. One of the most powerful forces in investing is compounding. It is a simple idea, yet its long-term impact can be extraordinary. Compounding occurs when investment returns begin to generate additional returns. Instead of earning profit only on the original amount of money, investors begin earning profit on the accumulated gains as well. Over time, this process creates accelerating growth. At first, the progress may appear slow and almost unnoticeable, but as the years pass, the effect becomes stronger and more visible. Small gains begin to multiply. Growth begins to build upon itself. The famous scientist Albert Einstein is often quoted as saying that compound interest is one of the most powerful forces in the world. Whether or not he used those exact words, the idea remains true. Compounding transforms patience into financial progress. Consider a simple example. An investor earns modest returns year after year and allows those returns to remain invested. Each year, the investment base becomes larger. As a result, the future gains also become larger. Over many years, this steady growth can turn small investments into significant wealth. But compounding requires one essential ingredient: time. Without time, the power of compounding cannot fully develop. Many investors interrupt the compounding process by trading too frequently. They buy and sell investments constantly, hoping to capture quick profits. This behavior resets the compounding process again and again. Instead of allowing growth to accumulate over years, the investor keeps starting from the beginning. Patient investors understand that time is their greatest ally. Warren Buffett is often used as an example of the power of compounding. Much of his wealth was built not only through intelligent investing, but also through decades of patient compounding. The earlier an investor begins and the longer the investment remains in place, the stronger the compounding effect becomes. Consistency is also important. Regular investing allows new capital to join the compounding process. Each contribution adds another layer of growth potential. This steady accumulation creates momentum over time. Compounding also teaches an important psychological lesson. Investors do not need extraordinary returns to build wealth. Moderate returns achieved consistently over long periods can produce remarkable results. This idea reduces the temptation to chase risky opportunities promising unrealistic gains. Instead of searching for dramatic profits, disciplined investors focus on steady progress. Charlie Munger once explained that the first rule of compounding is never to interrupt it unnecessarily. This simple advice highlights the importance of patience and discipline. By allowing investments to grow quietly over time, investors benefit from the natural expansion created by compounding. Another advantage of compounding is that it rewards consistency more than brilliance. Investors who avoid large mistakes and maintain steady habits often outperform those who constantly chase new strategies. This quiet and steady approach reflects the deeper philosophy of long-term investing. But even with the power of compounding, investors must maintain emotional balance. If personal identity becomes too closely connected with individual investments, emotions can interfere with rational decisions. Learning to separate personal feelings from financial decisions becomes the next important step in mastering investor psychology. This leads to the next principle. Rule 17. Separate identity from investments. Many investors become emotionally attached to their investments. They begin to see their choices not simply as financial decisions, but as reflections of their intelligence and personal judgment. When this emotional connection becomes strong, investing can turn into a psychological struggle. If an investment performs well, the investor feels proud and confident. But when an investment performs poorly, the investor may feel embarrassed, frustrated, or even defensive. This emotional attachment creates several problems. First, it becomes difficult to admit mistakes. When investors believe that selling a losing investment means admitting personal failure, they may continue holding that investment even when the original reasons for owning it have disappeared. Second, emotional attachment can cloud judgment. Instead of evaluating the situation objectively, the investor begins defending the investment as if defending personal reputation. In reality, investments are not personal identities. They are simply decisions made under uncertainty. Every decision in financial markets involves incomplete information and unpredictable outcomes. Even the most experienced investors make mistakes. Charlie Munger once explained that wise people are willing to change their minds when new evidence appears. This flexibility allows investors to adapt when conditions change. Separating identity from investments makes this flexibility possible. When investors view their holdings as temporary decisions rather than personal symbols, it becomes easier to evaluate them honestly. They can ask rational questions. Has the business changed? Has the original investment thesis become weaker? Are better opportunities available elsewhere? These questions encourage clear thinking rather than emotional defense. Another advantage of separating identity from investments is emotional stability. When investors do not attach their self-worth to individual outcomes, they remain calm during market fluctuations. A declining price does not feel like a personal defeat. A rising price does not create excessive pride. Instead, each movement is simply part of the natural rhythm of markets. Ray Dalio often emphasizes the importance of separating ego from decision-making. He believes that the desire to protect one ego can prevent people from recognizing mistakes and learning from them. Removing ego from investing helps investors remain open to new information and better ideas. This mindset also encourages intellectual humility. Humility allows investors to acknowledge uncertainty and accept that not every decision will succeed. It encourages careful analysis and thoughtful risk management. Warren Buffett has often demonstrated this humility by openly discussing investments that did not work as expected. Rather than hiding mistakes, he treats them as learning experiences. This attitude reflects the mindset of a rational investor. Investments are experiments in a world of uncertainty. Some will succeed and some will fail. What matters is the ability to evaluate each decision objectively and continue improving over time. By separating identity from investments, investors gain freedom from emotional attachment. They become more flexible, more rational, and more resilient. This emotional balance becomes especially important during periods of market crisis. During sharp market declines, fear spreads quickly. Investors who remain emotionally detached from their holdings can evaluate situations calmly and recognize opportunities that others may miss. Understanding how to stay calm during these difficult moments becomes the next important step in mastering investor psychology. This leads to the next principle, Rule 18. Stay calm during market crises. Financial markets move through cycles. There are periods of growth and optimism when prices rise steadily. There are also periods of uncertainty and fear when prices decline rapidly. These difficult moments are known as market crises. During a crisis, the emotional atmosphere of the market changes dramatically. News headlines become alarming. Experts warn about economic problems. Investors watch prices fall and begin to worry about the future. Fear spreads quickly through financial markets. Many investors respond to this fear by selling their investments immediately. They believe that escaping the market will protect them from further losses. Unfortunately, this reaction often leads to one of the most common investing mistakes. Selling during moments of panic usually locks in losses at the worst possible time. History shows that markets eventually recover from crises. Economic activity continues, businesses adapt, and innovation moves forward. Investors who panic and sell during the decline often miss the recovery that follows. The famous investor Peter Lynch once said something that reflects this reality. Far more money has been lost by investors preparing for corrections than has been lost in the corrections themselves. This statement highlights the psychological nature of market crises. Fear can cause investors to make decisions that damage their long-term results. Successful investors prepare themselves mentally for these challenging periods. They understand that market volatility is not unusual. Declines and corrections are natural parts of financial markets. When investors accept this reality in advance, they are less likely to react with panic when a crisis appears. Another helpful mindset during market crises is focusing on business fundamentals rather than market prices. When the price of a strong company falls temporarily, the underlying business may still be healthy. Customers continue buying products. Employees continue working. The company continues operating. The market price may simply reflect temporary fear rather than permanent damage. Warren Buffett once offered a calm perspective on market volatility. He explained that market declines can create opportunities for patient investors who are prepared to act rationally when others become fearful. This idea reflects the importance of emotional discipline. Investors who remain calm during crises are able to evaluate opportunities more clearly. Instead of reacting to fear, they ask thoughtful questions. Has the long-term value of the business truly changed? Or is the market reacting emotionally to temporary uncertainty? Howard Marks often explains that the greatest opportunities in investing appear when fear dominates the market. But recognizing those opportunities requires courage and calm thinking. Another important habit during crises is maintaining perspective. Short-term market declines may feel dramatic, but when viewed over long periods, they often appear as small fluctuations within a larger upward trend. Looking at historical market charts can remind investors that previous crises were eventually followed by recovery and growth. This perspective strengthens emotional stability. It helps investors avoid the trap of believing that current problems will last forever. Patience and discipline are especially valuable during difficult markets. Investors who maintain these qualities protect themselves from panic-driven decisions. They allow time for economic recovery and business growth to restore value. Market crises therefore test investor psychology more than investment knowledge. The ability to remain calm while others panic becomes a powerful advantage. But maintaining this calm mindset requires continuous learning and reflection. Financial markets evolve over time. New industries appear, technologies change, and economic conditions shift. Investors who remain curious and committed to learning can adapt to these changes with confidence. This ongoing process of learning and improvement leads to the next important principle. Rule 19. Keep learning continuously. Financial markets are constantly changing. New technologies appear. Industries evolve. Economic conditions shift across different countries and regions. Because of these changes, investing is not a skill that can be mastered once and then forgotten. It requires continuous learning and adaptation. The most successful investors treat learning as a lifelong habit. They read books, study financial history, analyze businesses, and observe how markets behave during different economic cycles. Each new insight strengthens their understanding and improves their judgment. Charlie Munger often emphasizes the importance of lifelong learning. He once said that the best investors are learning machines. This idea reflects a powerful truth. Knowledge accumulates over time, just like financial capital. The more an investor learns about businesses, human behavior, and economic patterns, the clearer the market becomes. Continuous learning also helps investors avoid repeating mistakes. Markets have experienced many different events throughout history. There have been bubbles, crashes, booms, recessions, and technological revolutions. By studying these historical patterns, investors gain perspective. They learn that market excitement and fear often repeat in similar ways across generations. George Santayana once wrote a famous observation about history. Those who cannot remember the past are condemned to repeat it. This wisdom applies strongly to financial markets. Investors who study past market behavior are better prepared to recognize similar situations in the future. Learning also expands an investor circle of competence. The circle of competence refers to the areas of knowledge where an investor understands businesses and industries well enough to make thoughtful decisions. Warren Buffett often speaks about the importance of staying within this circle. He explains that investors do not need to understand every industry in the market. Instead, they should focus on the areas where they can develop deep understanding. Over time, continuous learning gradually expands this circle. An investor who studies businesses carefully may begin to understand new industries and opportunities that were once unfamiliar. Another benefit of continuous learning is intellectual humility. The more investors learn about markets, the more they realize how complex and unpredictable the financial world can be. This awareness encourages caution and thoughtful decision-making. Instead of believing they already know everything, wise investors remain curious and open to new ideas. Ray Dalio once explained that successful decision-makers constantly seek to understand reality more clearly. Learning is the process that helps them achieve this clarity. Reading books, studying successful investors, analyzing financial statements, and observing market behavior all contribute to deeper understanding. Over time, these small efforts accumulate into valuable knowledge. Continuous learning also strengthens confidence. When investors understand the businesses they own and the principles behind their strategies, they are less likely to be influenced by market noise or popular opinion. Their confidence comes from knowledge rather than speculation. This calm confidence allows them to remain patient during uncertain markets. However, knowledge alone does not guarantee success. Investors must also develop a clear philosophy that guides their decisions. Without a guiding philosophy, knowledge may become scattered and inconsistent. A well-defined philosophy acts like a compass that helps investors navigate complex financial markets. Understanding how to build this personal framework becomes the next step in mastering investor psychology. This leads to the next principle. Rule 20. Develop a personal investing philosophy. Every successful investor follows a set of guiding principles. These principles form what can be called an investing philosophy. An investing philosophy is a clear framework that explains how an investor thinks about markets, risk, and long-term wealth creation. Without such a philosophy, investors often move from one idea to another without consistency. They follow trends during market excitement and abandon those trends during market fear. This lack of direction leads to confusion and emotional decision-making. A clear philosophy acts like a compass. It guides investors through uncertain markets and helps them remain disciplined even when emotions become strong. Warren Buffett. Philosophy focuses on understanding businesses, buying them at reasonable prices, and holding them for long periods. Other investors follow different approaches. Some focus on growth companies with strong innovation. Others prefer diversified portfolios that track broad markets. The specific method may differ, but the presence of a consistent philosophy is essential. An investing philosophy usually includes several key ideas. First, it defines how an investor evaluates opportunities. Some investors study company fundamentals such as profits, management quality, and competitive advantages. Others focus on long-term economic trends or broad market exposure. Second, it defines how risk is managed. A philosophy may include rules about diversification, margin of safety, or limits on how much capital can be placed in a single investment. Third, it defines time horizon. Some investors focus on short-term trading, while others concentrate on long-term ownership of businesses. For many successful investors, the long-term perspective proves to be the most reliable approach. Benjamin Graham emphasized the importance of rational thinking and value. His philosophy encouraged investors to focus on intrinsic value rather than emotional market prices. Charlie Munger added another important dimension to investing philosophy. He believed that good decision-making comes from combining multiple areas of knowledge such as psychology, economics, and business understanding. These ideas show that an investing philosophy grows through learning and experience. It does not appear instantly. Instead, it develops gradually as investors study markets, reflect on their experiences, and refine their principles. One important feature of a strong philosophy is simplicity. If an investment approach becomes too complicated, it may be difficult to follow consistently during stressful market conditions. Simple principles are easier to remember and apply. Another important feature is adaptability. Markets evolve over time. New technologies appear, industries change, and global conditions shift. A flexible philosophy allows investors to adjust their understanding while still maintaining their core principles. Ray Dalio once explained that principles act like decision-making tools. They help people handle complex situations by providing clear guidance. This idea applies strongly to investing. When investors develop clear principles, they spend less time reacting emotionally and more time applying thoughtful judgment. A personal investing philosophy also strengthens confidence. When investors understand the reasoning behind their strategy, they are less likely to be influenced by crowd opinions or short-term market noise. They remain focused on their long-term goals. Over time, this clarity becomes a powerful advantage. Investors who follow a consistent philosophy develop discipline, patience, and rational thinking. These qualities are the foundation of long-term financial success. However, even the best philosophy must ultimately be supported by one final quality. That quality is discipline. Discipline ensures that principles are followed consistently, even during emotional market conditions. Without discipline, even the best strategies can fail. Understanding the power of discipline brings us to the final principle. Rule 21. Discipline creates lasting success. At the heart of successful investing lies one powerful quality. That quality is discipline. Discipline is the ability to follow principles even when emotions try to pull you in another direction. It is the quiet strength that keeps investors calm during excitement and patient during uncertainty. Many people understand the basic rules of investing. They know that patience is important. They know that buying quality businesses at reasonable prices is wise. They know that emotional reactions can cause mistakes. Yet knowing these ideas is not enough. The real challenge is applying them consistently over many years. This is where discipline becomes essential. Financial markets constantly test investor discipline. During rising markets, excitement spreads quickly. Friends talk about profits. News headlines celebrate new highs. In these moments, the temptation to chase popular investments becomes strong. Later, the cycle changes. Markets decline, and uncertainty appears. Fear spreads through headlines and conversations. During these moments, the temptation to abandon investments becomes equally strong. Discipline protects investors from both extremes. Warren Buffett once explained that successful investing does not require extraordinary intelligence. Instead, it requires the ability to control impulses that cause others to behave irrationally. This insight highlights the role of discipline. Disciplined investors remain calm when others rush into excitement. They remain patient when others panic. They continue following their principles even when market emotions become intense. Another important aspect of discipline is consistency. Long-term wealth is rarely built through one brilliant decision. It is built through many steady decisions repeated over many years. Saving regularly, investing thoughtfully, avoiding unnecessary risks, allowing compounding to work over time. Each of these actions may appear simple, but their power comes from consistency. Charlie Munger often reminds investors that the secret of success is not brilliance, but avoiding foolish mistakes. Discipline helps investors avoid these mistakes. It prevents impulsive decisions driven by fear or excitement. It encourages careful thinking and patience. Discipline also supports long-term focus. When investors remain disciplined, they are less distracted by short-term market noise. They concentrate on business fundamentals, long-term growth, and the steady progress of compounding. This focus creates clarity and stability. Another benefit of discipline is emotional balance. Investors who practice discipline develop the habit of pausing before acting. They examine situations carefully instead of reacting instantly. This pause often prevents costly mistakes. Over time, disciplined investors develop confidence in their process. They trust their principles and remain steady even during difficult markets. George Soros once explained an important idea about investing. He said that success is not about being right all the time, but about managing outcomes wisely. Discipline allows investors to manage these outcomes effectively. It ensures that mistakes remain small and successes have time to grow. When discipline becomes a habit, investing becomes less stressful and more purposeful. The investor no longer reacts to every market movement. Instead, they follow a thoughtful path guided by principles and patience. Mastering investor psychology therefore leads to a powerful transformation. The market may remain unpredictable. Prices will continue to rise and fall. News will continue to create excitement and fear. But the disciplined investor remains steady. They understand that long-term success does not come from predicting the market perfectly. It comes from controlling behavior, following sound principles, and allowing time to work. With discipline, patience, and clear thinking, investors create the conditions for lasting financial success.